to day 2 of 17 Summit. I'm really excited to be here with you today, and thank you all again for coming back and joining us on day 2. I hope you really enjoyed day 1. My name is Sarah Corley. I'm CEO of the Alliance of Digital Finance Associations and also Divisional Director at DFI. So it's an absolute pleasure to be with you here today. In the last 18 months, we've learned a lot about the importance of financial resilience. We often talk about savings and credit, but I feel really now insurance needs a turn in the spotlight. My personal passion and interest in insurance stems from many conversations I've had with our 2 guests today. So I'm delighted that actually we get to share and involve you in our conversation. So I'd like to welcome Jeremy Leach and Jeremy Gray. Welcome.
Hi, thanks. Nice to join you. It's good to have the 2 Jeremys back again together.
And you've given me a tongue twister because now I'm going to have to say your full names every time I ask you guys a question. But that's a small price to pay to have such wonderful experts on our panel with us today. So let me introduce you both first before we get started. Jeremy Leach specializes in inclusive digital insurance and has been involved in advising, researching, and implementing innovative insurance initiatives across the world. Jeremy has played executive roles in private and public sector and is currently founder of an award-winning inclusive fintech, Inclusivity Solutions. They build, design, and operate inclusive digital insurance. We also have Jeremy Gray, who is the resilience team lead at Cenfri, where he manages research to enhance the developmental impact of the financial sector. He has a particular focus on building resilience in developing countries and understanding the interaction of consumers, providers, and regulators at a market systems level to identify interventions that will improve the value of financial services to the largest number of people within developing countries. So you can rest assured, everyone, that you're in great hands today with us. So I'm really excited to get started in talking about embedded insurance, but I think a good place to start, right, is to actually help us make sure we're all on the same page and understand, what is embedded insurance and is it a game changer? How is it different? Jeremy Gray, perhaps you can kick us off.
Yeah, thanks, Sarah. I think embedded insurance is, in the simplest term, is really an insurance policy that's sold together with another non-insurance product. I think you can define it slightly differently. Jeremy might disagree with me slightly, but embedded insurance can be free, so you can offer it as a loyalty benefit, or it can be paid for and mandatory, like we see with credit life insurance. I think the key point is that embedded insurance piggybacks on the sale of another service, which makes it that much easier to distribute the product, because you distribute the insurance policy because it's distributed with an existing product, so reaching an existing consumer base. But then secondly, a key component to make it work is that it's embedded with a service that also has an ongoing payment required. So that collection of premiums is done also in a bundled way with the core service that is being sold. So I think, is it a game changer? I mean, I think I don't know if I'd say it's a game changer. It's something that's certainly been around for a long time. Credit life insurance, I think, is one of the oldest forms of retail insurance. I stand corrected here, but I think if you look globally across the developed world as well, a significant portion, if not the bulk of retail insurance, so non-corporate or commercial policies, would potentially be considered embedded if you consider employee benefits and credit life as particularly in particular large categories for those. But it is important, and I think Jeremy can talk a lot more after this about, inclusivity really is built a lot of their business model around this, as has a number of other key players that have been able to reach really new target markets that would otherwise not be able to reach by offering embedded insurance. So I don't know if it's a game changer in the sense it's been around for a while, but I certainly think it's a really important part and an important enabler of improving access to insurance across developing countries.
Yeah, I don't know if I can kind of come in there, but no, I'd agree with that. And I think it is it's funny that's going to, we have the kind of the classical hype curve, and we're now the hype curve of embedded finance, embedded insurance, which, as you say, is basically a very, very old insurance. I mean, if you look at most insurance, from credit life or warranty cover, when you buy your fridge and you get insurance, that's a form of embedded insurance, and that's been around for a very long time. kind of on that side. So there is a new kind of hype around it. But what I think the difference is, it's about the application of technology and the user experience, which has changed more so rather than the actual approach of embedded insurance. And again, I think Jeremy referred to whether it's loyalty at no cost or whether it's paid for the customer and it's mandatory. But I mean, now they've got a lot of what the literature talks about is embedded is, would you like insurance with that? So I buy a bike. Would you like insurance with that? Would you you make a money transfer? Would you like insurance with that? And just add it onto the transaction kind of as far as possible. And where the technology aspect comes in, and maybe where it's, then it's sort of, would you say it's a game changer because it is a very old model, but it's the improvements in the customer journey, the customer interface, and the linking into that that arrangement, where previously the old embedded insurance was pretty manual. I remember you're getting your fridge and you get your warranty. You've got a piece of paper. I very rarely use paper these days, but I took paper just in case I need to write notes. But you have to fill these long documentation in, then they kind of send off to the insurer before it's kind of validated. What's happening now with technology is you're very much more of a seamless engagement. You're pulling your data in from the purchase of the product, and it's automated as far as possible. And that's what's, I think, changing in terms of the new form of embedded insurance as it is.
And Jeremy, in many conversations, Jeremy Leach, you and I have had, you've said that insurance is not an easy sell, nor is it an easy to collect. I think that is one of the biggest challenges that insurance face. So I'm assuming that embedded insurance definitely brings some advantages for you there. But what other benefits can it bring the partners involved? So both the insurance provider, but also the person who's the product or service that is being bought with that.
Sorry, just wondering if it was Jeremy's. It was very quickly, but I think there's, so I mean, I think in terms of kind of benefits, and again, I think we can talk more broadly kind of around that. I guess at the crux of insurance, we see two biggest challenges to address are the distribution. How do you get customers on the one hand, and it's often the old saying grudge purchase with some exceptions, and the second is what we call frictionless payments, the payments model. And if you haven't got frictionless payments, insurance does not work. The opposite of frictionless payments is the push payment model, which is pretty common in the rest of Africa, where in order to pay a premium, you have to initiate your payment on a month-by-month basis. And there's a lot longer discussion around why that's happening because of the both regulatory, but also the technical platforms around mobile money and such like. So there's push payments where you have to initiate the payment yourself. That probably works okay for annual insurance premiums. It works for when you pay electricity. So if I don't pay my electricity, I'll be cooking for my family in the dark because my wife would not be very happy with me. Or when you pay for your airtime, you people can't communicate. So there's immediate repercussion if you don't pay insurance. If you don't pay your premium, you actually don't have the cover when you need it the most. And that's tragic for the person, but it is not top of mind. So it's harder to justify push payments. So again, the embedded insurance space is very much in that focus of frictionless payments, ensuring that you can address kind of a payment model as effectively as possible, whether somebody else pays or it's paid alongside the product or service. And I think that's really exciting in that space. If you can get those models right, and there is geographical differences. I think in Africa, we're still seeing a lot of challenges around frictionless payments, less so in some of the Asian markets, kind of interestingly. And so I think the benefit is about the clearer distribution model. So we've got insurance where when you do a money transfer with NTN and MFS Africa, you pay your insurance premium as well. When you buy airtime or data with Equity Bank, you're actually paying for your insurance premium as well. So we've got a number of those use cases where insurance is aligned to the customer journey and you address that frictionless payments issue. I would say, just expanding that a bit before, there's also major risks. And I think Jeremy Gray would agree with me. If you look at the abuse of credit life, where, I think in South Africa a few years ago, less than, I can't remember, it was like 20% of people knew they had credit life or less. Huge abuse in that space. We've seen similar issues in the UK. So embedded insurance at the same time has huge risks that clients are getting this cover but have no understanding of what the insurance is involved. And so we also need to really unpack that and make sure that we delight customers, get them really engaged and understanding in the customer journey, and ensure that the cover is there when they most need it.
I think if I can briefly add to what Jeremy just said, because I really wanted to highlight this, which is that Jeremy really articulated well the benefits for the insurance provider, but it really also needs to speak to the partner. It needs to and I think what we often see, Jeremy can speak from much better direct experience than me, but certainly from the discussions that I've had, often you need to sell a product or offer a product or design a product that not only meets the needs of the end customer, but also needs to speak to the direct business model of the partner as well. So, for instance, credit life works when it's able to mitigate the risk of the lender, because then there's an incentive for that lender to continue embedding that insurance policy because it mitigates their own risk. What I think where we've seen, I think some of the challenges, so Jeremy talked, credit life is definitely has been subject to significant abuses because of the mandatory nature of the embedded insurance. The other is that, though, that we've seen is like the large MNOs, for example. We saw over the last decade or so, at different times, insurers really rubbing their hands in glee as they realized MNOs are increasingly reaching significant portion of the population, and that through a single embedded policy, they can suddenly grow their consumer base to 2 or 3 million customers. But we saw most of those models last for like 12 to 18 months and then collapse. And actually, I'm going to cite some research that Jeremy Leach did, which in Zimbabwe, when after initially the first round of the EcoNet offered Eco Life as an embedded product with some partners. And that partnership kind of fell apart, I think, after about 12 to 18 months. And Jeremy actually did some qualitative research in Zimbabwe that indicated that all those people that had that insurance cover felt really let down by the insurance industry as a whole and really undermined their trust in insurance, not just in those providers, but in the insurance as a concept or insurance as a product. And I think that happened in Zimbabwe. It was quite stark in Zimbabwe, but it's happened in most countries across the continent, actually. We've had these MNO models rise and then fall. And I think the key part here is that it needs to speak to the needs of the partner to ensure that there's an ongoing reason why they want to continue offering it. Like for MNOs, there's a peripheral business case for them to distribute insurance. It's a marginal revenue stream if they're earning revenue, or if it's a loyalty benefit. I think there's evidence that suggests it does increase loyalty, but typically only over a relatively short period of time. But then you do, as Jeremy says, it also needs to be continually meeting the needs of consumers as well, because if you're only meeting the needs of partners, that's also where that exploitation comes in, and potential for consumer abuse.
Yeah,
I guess that's one of the challenges that we're facing here. Is not just that one person we're trying to design for. It's actually, you've got 3 key important parties involved: the insurer, the partner, and the consumer at the end. So I guess sort of the next question, I'll put to you both, but for those who are on low or unstable incomes, we know that there are many, particularly in Africa and Asia, where we work and we focus a lot. How can embedded insurance work for them? What benefits can it bring? How can we do it in a way that they would think insurance is great, as opposed to being quite skeptical of insurance, which I'm sure, or not even being aware of it, which we know is where many people are sitting right now. Jeremy Leach, shall I start with you and then come to you, Jeremy Gray?
Okay, that sounds good. And I do want to ride back to Jeremy's last point. I think there's some really rich kind of insights and thoughts in there as well. I mean, certainly in terms of the low unstable income, I mean, certainly the benefit of embedded insurance is that you're often linking an affordable cover, as I say, linked to the core product and service the client is seeking. And one of the major challenges which you see from research across the continent is that insurance is either overly complex, expensive, and really not suited to the mass market space. So the exciting thing around the embedded insurance aspect is you're now really thinking around the customer linked into a particular transaction. So you've got a product, I mean, there could be many, remittance, but if you're say paying a certain say $100 in kind of remittance, you can't then charge them $50, $60 for premium, for example, or annual cover, which is often common. You've got to link the premium so it's affordable related to the kind of core product and service. So you're buying kind of airtime in a market. Again, if you're doing like a $5 airtime, which is often a lot less, by the way, you're only going to be able to add on a few cents or so for the premium. Otherwise, it becomes unaffordable to the client. So again, we're seeing with these embedded models, you're essentially changing the insurance construct from one which is often a voluntary or high expensive product in a niche part of the market to a mass market proposition that has to be very seamless with the distribution partner, and also affordability linked to the core product or service. So we are seeing better products coming on board, better as a, we'll come back to that, but also more affordable products as well, because I think that's the benefit. And that means you can also reach a large kind of reach of people, which certainly goes into that kind of the low mass market in a big way. And a lot of our clients are very much those who haven't had insurance kind of previously as well. So I think that's certainly one of the benefits of that embedded insurance kind of angle. If I may go back to Jeremy's last point around the Econet research, and yeah, I mean, that's actually a really powerful piece of research in Zimbabwe. It's actually still available on the Cenfri kind of website, although it's a few bit outdated. But what's been interesting around the mobile operator space, and more broadly in terms of the loyalty insurance, was we're seeing that those loyalty models can be very valuable. I think in one case we've seen, we did some research actually with kind of Cenfri's team, where we saw there was a 56% sustained increase in spend because of insurance on a loyalty product. With a kind of a major kind of a player in kind of East Africa. We've seen in other markets 160% increase in spend because of the insurance, in that clients are changing their behavior, becoming more loyal and spending more because they're getting essentially loyalty cover as a reward for certain behavior. But again, there's a few things you need to think through. You need to think through design that is really meets the needs of the customer, the customer engagement, and obviously making sure that it is kind of claims, there are claims. And again, part of the challenge from some of those loyalty models which fell away is claims were so small, it was basically not a suitable product. It wasn't insurance, it was a marketing gimmick in some ways, and because the claims ratios were just so negligible, again, the value to both to the end client, but actually to the insurer, the mobile operator was also very low, because essentially by paying claims, you're providing value to the clients of the mobile operator, and they're seeing real value coming through, as well as obviously changing behavior. So you need to, again, as you said earlier, have that combination of meeting the interests of the client, decent, simple products that are accessible with effective claims process to paying out. The insurer needs to see real distribution partner needs to see real value, that clients are excited, engaged, and receiving significant claims, and obviously needs to be viable on the insurer side. And I think we're also kind of seeing, as the shift where a lot of those loyalty models fell out, and there's a particular player that was quite influential in the numbers, we're seeing other models coming through in a big way, where you're seeing big changes on the loyalty driving change of behavior, but also driving conversions to paid products. I think you've all seen MTN IO reporting remarkable numbers actually in terms of take up, and of all intents and purposes, hearing dividends are about to be paid out. So again, you can see that means it's becoming viable business because they've got the loyalty and the paid side as well. Obviously, it's a lot complex there. So you can see those models working, but you really need to understand the needs of the customer, the needs of the various stakeholders, and design it effectively. And just for example, in claims, we get some flack for this, but Nigel Bowman, a co-founder, did a paper when I was still affiliated with Cenfri, and said that you should aim for claims of around minimum of 40% to be of value to the end customer. And actually, your insurers are saying 40%, no way. But we need to ensure claims are at a healthy level to demonstrate the value of insurance and make it sure it's a sustainable, viable business in the long run.
Yeah, I mean, to add on that, and this is an anecdote too, I won't mention names, but I recall having a discussion with an insurer a few years ago who were very proud of the fact that they offered a product with an MNO, and very proud of the fact that they had received 47 claims on a book of 1.1 million customers after it had been in operation for more than a year. So I think Jeremy's point is fundamental. The one other key point here, and I think, Jeremy, you're the one who actually, I think, first mentioned this to me, but it's absolutely critical, is that it's not just about ensuring that there is value there. It's also about making sure that you measure that value, because you need to be able to demonstrate to the partner that there is value from this product, whether it's a loyalty product or even if it's a paid for product. And we can see it with both ways. The partner needs to see that there's direct benefit to them. And if you don't have that proper measurement, that effective measurement up front and put in place to be able to demonstrate to them how it's benefiting their core business model, it's a really hard sell with their board, with the exco, with whatever the case is. And I think this is what you guys have built in quite deliberately into a lot of your partnerships.
Yeah, no, absolutely. I mean, I have to say, at the different levels, I mean, we put a lot of our treasure into upfront research to design products around the needs of the customer. There's all these anecdotes and longer discussion around taking a product from South Africa or Ghana, take it to another country, and it flops. or it's seen as a curse because you don't talk about death in certain markets. So we invest a lot of that research to make sure your products are suitable for the client, but also that distribution partner, it resonates with the partner, whether it's a bank, mobile operator, or a platform or such like. Needs to resonate because you've got to see customer value. Like Jeremy said earlier about credit providers or banks, they need to see credit life being relevant to their business model. In the same way, we invest research to understand how to adapt products to their customer, and of course ensure that we provide the data to them of how clients are changing behavior, how clients are claiming, and actually one of the bigger benefits I think around I'd probably embed insurance, or at least what we do in terms of ensuring transparency, is that distribution partners want to see value to their customers. So they hold the insurers to account. They can't do 48 claims of a 1.5 million book or whatever, because again, the distribution partner says, why are we supporting this? It's basically irrelevant to us and our customers. So again, and we have our dashboards of our partners, you can see all partners have a clear view of exactly how many claims are paid, how long it takes to do it, because you can't have paying claims in 30 days. Again, it just creates discontent for the distribution partners' clients. And again, by ensuring transparency, ensuring value, and paying claims, you're going to help grow the market overall and ensure that all the parties are aligned.
And we've had a couple of interesting questions come in on the chat, and if you haven't put your question there, I encourage you to do so. We've got a few more minutes left before we end today's session, but we've had one from Honorare, and I think it's a really good question. So how do we make sure that embedded insurance doesn't then become too costly for the customer? How do you manage to make it affordable in line with whatever product or service that the customer is buying? Maybe Jeremy Leach, you can start off with that one, seeing as you are delivering those kind of services.
Yeah, it's interesting. I mean, there's an old book by Professor C.K. Prahalad. I think most people know about it. Unfortunately, at the bottom of the pool. But I mean, I'm talking about a specific angle. He talks about price performance. You first start at the affordability level. And once you know what is affordable, then you build the cover, essentially the premium or the cover around that. So again, I think the point is we need to start first at understanding what is affordable at a particular segment of that base, and then building the cover around that. And as you're using digitization, you're bringing on the platforms, you're bringing in customer, smooth processes, you can obviously eliminate a lot of the cost of the models. I mean, I know, again, one platform we delivered recently, I mean, we've reduced not a good thing in terms of employment, but before it took 4 people to support sign up of a group, basically a group scheme, and it's doing this like 30 days, sadly, to one person, closing it in a couple of days. So again, it means that you're making it more efficient, you're cutting costs, and also, most importantly, delighting your customers, whether it's a individual, whether it's a group. And that again allows you to be more efficient and offer more cost-effective kind of premiums in the market.
And I think there's real opportunities when you can embed mutually supportive products together. So Credit Life has been open for exploitation, but I think it can also, when designed cleverly, it can also really be unlock value that having the 2 products together more than offering them separately. So two examples. We worked with Turaco Insurance they provided insurance in Uganda and Kenya, and they were offering an insurance product as an incentive for purchases of basically asset-based loans. They were purchasing solar panels, and they received insurance if they paid back their loans more quickly. And they found that that insurance as an incentive to pay back their loans did drive loan repayment for the core loan provider. So they were able, it was actually in the interest of the lender to subsidize or even fully cover that insurance payment, because they more than made up for it in terms of the quicker loan repayments on their books. So again, that's one example. The other one that I really like is SA Taxi in South Africa, which is the member association for taxi owners in South Africa. And they started off by offering loans to their taxi drivers, but they found that their taxi drivers really loans to purchase new vehicles. And they found that it was really difficult for them to get affordable insurance from the market, because insurers considered them to be far too expensive or far too risky as clients. Basically, the taxi industry doesn't have a great reputation. So what SA Taxi did was they got their own cell captive model, and they then started offering insurance themselves bundled together with their credit, with their own credit provider provision. They then added an additional sort of leg to that by also offering panel beating service in-house. So they were able to do panel beating more cheaply because they had a captive market, because they knew all their drivers would be coming to their panel beating services. They offered loans, and they added telematics to track the driving behavior of their drivers. So so all these three services basically provided captive markets for each other and helped to de-risk each other to some extent. In turn, basically meaning that they unlocked additional value because of the integration of the three services, and were able to more than halve the insurance premiums for the taxi drivers as a result. It's a really clever model, and it's not always possible to replicate, but I think those opportunities where you can embed insurance in a way that supports multiple objectives then creates incentives to also reduce the cost to the end customer.
I love that. I love that that multiple incentives, multiple values for all three of the parties, or however many are involved. I think that seems to be what I'm hearing from you both as being the key to make embedded insurance work well, and to avoid some of those pitfalls that we've spoken about with low value, low usage, low claim rates. So as we enter our last couple of minutes together, I'd love to both hear from you. What new and interesting opportunities, or things out there should we look out for? What is coming our way that we should keep an eye on? Maybe we start with you, Jeremy Leach.
Let me hand over to Jeremy Gray.
Okay. Jeremy Gray.
I think Leach is probably better positioned for this one, but to me, I think what is I think this ensuring that we offer value to all the multiple players within the value chain is key to making these models work. And I think it's not even just about embedded insurance. I think making insurance work, particularly for new markets, does require that as a critical prerequisite. And I think what we're seeing as being of interest to us, at least, is some of the emerging aggregators from digital transformation that we're seeing across the world. So we're seeing digital platforms, in particular online marketplaces, increasingly reshaping the economy and the way in which people interact with each other. The pandemic has accelerated that further. And I think these offer, firstly, really interesting aggregation opportunities to distribute insurance as well as other financial services and non-financial services as well. But there's also often a strong incentive for those platforms themselves to offer insurance to ensure consistency of supply. For example, if they are a food-related platform, like Alibaba, for example, offers widespread insurance to all its suppliers because it really needs to de-risk its supply chain as far as possible. One thing that we looked at recently, we did a study across 9 Asian countries looking at the potential of app-based digital platforms for first mile logistics, so from farm to table logistics, basically. And I think what's really interesting there is that, similar to like an Uber type model, for logistics, for transport providers, those type of platforms are beginning to emerge. But for them to be successful, they need to scale. And to scale, what they need drivers and logistics companies, so SMEs, who are efficient, who can afford to purchase large trucks, because large trucks and large new trucks are a lot more efficient than old small trucks, which is what we see across most of the logistics sector, across most of the developing world. But that requires a significant lump sum of capital, which most logistics SMEs don't have access to. So what these platforms need to enable in order for the platforms to be successful and to create a viable market for logistics services is they need to give access to users on their platform, to providers on their platform, to capital from lenders. But because lenders see that as a risky business, they need to be able to de-risk that investment. So they need to offer insurance and other risk management solutions to also de-risk that. So I think that these types of things around unlocking opportunities through different value chains that offer incentives to improve reduce the risk and improve the consistency of supply across supply chains is, I think, a really interesting opportunity going forward. Yeah,
you can see why I suggest Jeremy go first from a bank perspective. But again, there's not much to add on that, except that the point is I think we are seeing through digitization more and more touch points coming through. I think we're still challenged in the rest of Africa because we're not seeing those same scaled platforms as we're seeing in those Asian markets. But I think with the increased digitization, smartphones and others coming on board, we'll see a lot more opportunities coming through. And I know we're out of time. Thanks for the time.
Thank you so much for joining us. It's been amazing. Insurance had its moment in the spotlight, and I hope that we'll have many more of these discussions to come. Thank you so much, both Jeremys, for joining us today, and I look forward to chatting with you soon.